Hello, everyone, and welcome to another Motley Fool conversation. I am Motley Fool contributor Rich Lamello, along with Motley Fool advisor and analyst Buck Hartzell. Today, we're honored to be joined by Bill Bernstein, a financial theorist whose work has left a lasting mark on both the world of finance and intellectual history. Trained as a neurologist, Dr. Bernstein made a remarkable transition into the world of investing, where he's since become a respected voice for individual investors seeking clarity and discipline in their financial lives. He's the author of numerous influential books, including The Four Pillars of Investing, The Intelligent Asset Allocator, and The Birth of Plenty, blending rigorous analysis with deep historical insight. Dr. Bernstein is known for both cutting through market noise and offering timeless principles rooted in data, history, and rational thought. Bill, welcome.
Glad to be here.
Excellent. Well,
it's great to have you.
Yeah, looking forward to a fun conversation here. And I guess I'll start off by just kind of saying you give a little bit of background about yourself, because like, as I mentioned, you're an MD in neurology, practicing in Oregon. And I guess, what brought about the switch to finance?
Well, first of all, thank you for pronouncing the state correctly. It's a shaggy dog story. I'll try and do it in 30 seconds, which is that I live in a country that doesn't happen to have a functioning social welfare system. So I was going to have to save and invest for my own retirement. And I approached it the way I thought that any person with scientific training would do, which is to read the basic texts, the peer-reviewed literature, collect data, build models, and go from there. And this gets to 30 years ago. And by the time I had done all that, I realized that I had done something that was of some value to individual investors. So I started writing. The web had just come to my neighborhood in the mid-1990s. And pretty soon I started getting calls from journalists. And that's how I wound up with a career in writing and money management.
Okay.
Yeah, that's great. And I'd say you've done a lot for the individual investor. And I know you've been on previous podcasts with Robert Brokamp and things like that. And one thing that really stands out to me is how you simplify things. And I think, there's a whole industry in Wall Street that's built around making things more complex than they need to be so that you pay them money. But you've done certainly a lot for the individual investor. We're going to jump into some questions. And I'll just say, part of my reading this summer is enough. And I've really enjoyed this book. You'll notice all these little dog ears that I have and notes that I've taken already. And I've already bought this book for multiple people. So I'm out there as a high net promoter on your work. So one group, Rich and I both have young adults. So people that are either getting ready to graduate or graduating college and got their first job. And I just had 10 of those people over at our house this weekend. And one of the questions that got asked during that conversation as we sat down is, how much do we need to save in order to be prepared and reach one day financial freedom? I don't like the word retirement because I think, freedom is something different. You can do what you love. You don't need to retire, and people aren't meant to sit around and watch TV on their couch and stuff. But can you give us an idea for those young people that are going to be watching this video and replay that are just getting started? How much is a reasonable amount do you think that they need to save in order to reach their goals, Bill?
Well, in recent years, I've changed my mind about this. I used to think that 15% was enough, which is the figure that you'll see in that particular book. And 15% is adequate if you have a relatively low income, because what will happen when you retire is you will get a very nice replacement ratio out of your Social Security. The person who has below average income or average income is going to get probably in the realm of about 50 to 60% replacement from Social Security. But if you're an upper end, and for that person, 15% is adequate. Okay. But if you're an upper income person, then Social Security may only replace 30 or 35% of your income, or even less if you've got a very high income. So that person should be saving at least 20% of their income.
Yeah. Well, they'll be happy to hear that, because I've been a little strict on the group that I was talking to, and I said, 15% is the number they throw out. But I was talking to some people that are going to be, I think, some pretty high earners. They're pretty smart and they have a lot of motivation to do well. And I said, but I know you guys, you can do better. the, early on, if you save till it hurts, and you can do 30 or 40% early on, that snowball starts to build and it gives you such a big head start. So I said, delay those purchases of cars and all that kind of stuff. If you can save till it hurts early, you'll do well. And I threw out 30 and 40%. So they'll be happy to hear the 20% from you.
Yeah,
That's
the
great.
easiest way to look at that is just to ask yourself, how much do well-funded pension plans put away for their employees who are covered by them?
Yeah.
And the answer is, when you add up the personal contributions, the employee and the employer contributions, it comes out to be pretty close to 30%. So when you put together your Social Security contribution and your personal savings, that's about what you should be putting away is 30%.
Yeah. That's great. That's great. And I'll throw one more in there that's relevant, certainly to Enough, the great book. And there was an important distinction that John Bogle, I think, made in that book, and I think it relates really well to you as well. He had a distinction between net worth and self worth that I thought is important for people to hear. And you're somebody that's changed careers. I mean, you were a highly educated person, a neurologist, and you did a career change. So I want to know, was that career change more about net worth or was it more about self worth?
Oh my gosh, it was about self-worth. You know,
Okay.
I would say that probably 30 to 35% of physicians were born to be physicians, and they're going to get carried out feet first. They love what they did, and they're going to practice as long as they can. But it's a sad fact that most physicians, and I count myself among them, probably 60 to 70% of physicians, are going to retire the first chance they get because it's a fairly brutal profession. And I
Yeah.
was among those. And so I found that I enjoyed writing and doing finance more than I enjoyed doing medicine. So I made the switch. It was just a natural, gradual segue that I executed.
Yeah, and that's great. And I'm sure among the young people that are going to be listening to this, there's going to be some career switchers in there. Do you have any advice for people that maybe are stuck in a job that they don't like that much, or that is a grind, or maybe they have a passion that they've kind of discovered that's outside of there? Do you have any advice for those people?
Well, it depends upon what financial situation you're in. If you can switch to something that has the same income, then do it sooner rather than later. On the other hand, if you're in a high earning position and you despise your job, then you should probably wait to make the switch until you have enough money to support yourself to follow your bliss. Following your bliss can be
Yeah.
pretty expensive. And
Yes.
if you're switching to something that doesn't pay a lot, then you should wait until you can afford to do that.
Right.
Mm.
That's good advice. It's good
I mean,
practical
it's one of my,
advice.
my favorite New Yorker cartoons. The term follow your bliss comes from, what's his name? James. Can never remember the guy's name now. But James Campbell. And it's a New
Okay.
Yorker cartoon. It's a guy standing in front of a tin cup on a sidewalk, and his sign says, followed my bliss.
Yes.
That's
Yeah.
great. Hey,
Yeah.
Bill, you've written that investing is simple but not easy. What do you think makes it so hard for most people to follow um, sound investing principles?
Well, there's a very precise analogy for that, which is losing weight. Losing weight is simple. Exercise more, eat less. It is not easy. It is also simple to say, I'm going to invest 15 or 20% of my salary every month into the financial markets. It's an easy thing to say that. But when the world looks like it's crashing down around you and maybe you're losing your job, it's not such an easy thing to do.
Okay.
Yeah.
And
The
are there
analogy, the analogy, the other analogy I like to use is if you've ever had any flight training, it's flying in a simulator. Preparing for an emergency or a crash landing in a simulator is easy. It's very non-stressful. Okay, I've done it. But doing it in the real world, unfortunately, I never had to do it. I imagine is a good deal more stressful. And the financial markets are the same way. It's one thing to have a plan in a spreadsheet or in a beautiful mathematical model. It's another thing to actually execute it in real time.
Yeah, and I guess a follow up to that is: are there misconceptions about risk that you see from your work and your writings that persist among both amateur and professional investors?
Well, we're human beings who evolved over millions of years of biological history, and the way that we react to risk, or the risk that we respond to, is immediate risk. It's seeing the yellow and the black flash of light in your peripheral vision, or hearing the hiss of a snake or the roar of a lion, and you respond just like that. All right, that's the way most people perceive risk in financial markets. It's the day that the market falls 3 or 4%, or when there's very bad economic news. That's not risk. Okay, that's volatility. What real risk is living under a bridge or eating cat food when you're old.
Right.
All right. And those are two entirely different kinds of risk. And unfortunately, people pay much more attention to the first kind of risk, the immediate risk, what I call shallow risk, than they should pay to deep risk, which is the second kind of risk, the long-term risk.
Okay. And if I could just follow up with one question on the back of that, is there a way for investors to kind of, I don't know, have or cultivate the discipline to do nothing during periods of market volatility? You mentioned those 3 and 4% down days. Obviously, 3 months ago, we had a 20% correction. Obviously you were rewarded if you just stuck. Is there a way to kind of cultivate that discipline?
Well, like everything else in life, there's theory and there's practice. The theory is to look at financial history and understand that, once every 3 or 4 years, the markets fall by 20%, and once every 10 or 20 years, they fall by 50%. So it's to have that knowledge in your knowledge bank. So it's to know that theory, but the theory isn't enough. All right. The practice part of it is to actually live through it yourself and see how you respond. And people respond in different ways. There are people who are utterly impervious to falling markets and will happily invest even in the worst of markets. They find it very easy to do. I find those kinds of people are very rare. I'm not one of them myself. All right. And there are other people who, when the markets do poorly and the world looks like it's going to end, they panic. I've known men who risk their lives in combat and seem to execute that very well. But on the other hand, when the markets, when their portfolio fell by 5 or 10%, they threw up. It's very odd.
Yeah. Yeah, it's funny, even business owners, people that run their own business and they've been through, swings and upturns and downturns and COVID and all this kind of stuff, and they can handle that fine. But then when they see their stocks go down 5 or 10%, it's something that kind of blows their mind a little bit. And I'm like, some of these people are friends. I'm like, you've run your business through all kinds of downturns and things that happen. Why does it bother you? And I think it's because they feel like they're in control of their business and they're calling the shots where the movements in these stocks. And I tell them, just don't watch. Like, this is long-term investing. If the up and down bothers you, don't look at it. Go play golf. You like that.
Yeah.
Right? Well, as I already mentioned, I like to think about things evolutionarily, and I like to think in terms of analogies as well. And the analogy I think it's appropriate here is the skunk. All right, the skunk evolved over tens of millions of years to have a given reaction to a large predator that threatened it, which is to turn 180 degrees, lift its tail, and spray. And that's very effective. But it's not effective in an environment where your major predator is a hunk of steel weighing 2 tons moving 60 miles an hour. That's not the appropriate response. And that analogy to finance is precise.
Yeah. Yes. Yeah, that is. That absolutely is. Now, I want to go towards a little bit diversification, because Four Pillars was a great book that you wrote and shared a lot of great lessons for people. But one of the comments in there was, when things look the brightest, returns are typically the lowest. And when things look the darkest, returns are the highest. And so I have a question for you today. We sit here July 22nd, 2025. Where do you think we are on the brightest to darkest continuum as far as investors today?
Not a lot of clouds in the sky that I can see. I mean, people are talking about tariffs and a debt spiral and the unsustainability of the Treasury market. But that's not the way people are behaving. People are behaving like everything's fine. And that's a really important concept because in the financial markets, you are paid to bear risk and uncertainty. So the worse things look, the lower prices have to fall in order to attract people back into the market with higher expected returns. So the best fishing is done in the most troubled waters. And the time to be wary is when things look the brightest. You know, Warren Buffett very famously said to be greedy when others are fearful and fearful when others are greedy. And people look pretty greedy to me right now.
Yeah, the risk trade seems to be kind of back on right now. I mean, with most people, and I'd say also stocks are relatively expensive, and it leads me into another question, and this goes to kind of diversification. A recent Wall Street Journal article, posted that over the last decade, small cap stocks have returned about 6.6%. That trailed large cap stocks that returned over 13%. So they trailed by about 7.3% per year. And that's the widest gap that we've seen going back the whole way to 1935, as they were mentioned. That includes dividends. So I just wonder, from an allocation standpoint today, where are you on small caps versus large caps? Can you just kind of give us, do you adjust your allocation based on how well that particular class has done or not done well the last 5 or 10 years?
Well, my discipline, my intellectual discipline tells me I shouldn't do that at all.
Okay.
But I have to admit that my emotionality when I see something like that tells me yes, I should act on it. So, whatever my given allocation was to small cap stocks, say 5 years ago, maybe it's a little higher now. Okay, just for that
Yeah.
exact reason. The financial markets do have a tendency to mean revert, which is what that article by Jason Zweig talked about. And that mean reversion is a relatively weak phenomenon. It's at best a 55-45 bet. But if you make enough 55-45 bets over the course of your lifetime, you're going to win some, you're going to lose some, but on average, you'll come out ahead. So,
Yeah.
I think that's a bet that's worth making, but don't be surprised if it doesn't work this time.
Okay. So intellectually, you say, I stick to my guns. I've had my allocation, but also you say, I might tilt a little bit more in that direction, given that recent data. And and can you give, for people that are listening at home, so they have an idea, what are your rough kind of allocations, would you say, in a simple form, to large cap versus small cap, and say international and maybe bonds in there?
Well, I think the typical investor is well advised to hold the market, the total stock market. And if they
Yeah.
want to tilt towards small cap stocks, they can do it with a small portion of that allocation, say a quarter or at most a third of it.
Yeah.
But understand that there are going to be long periods of time, like the last 20 years, when you're sorry you did that. So you have to be extremely patient.
Yes. Yes. Yeah. Patience is a huge thing for all investors to have, and it's generally rewarded. Rich, I'll pass it over to you for another
Sure.
question.
And Bill, Bucket also asked about international allocation. Where do you kind of see international on that continuum? And then also, I would ask about other asset classes, commodities or REITs. Do you have a place for that in your allocation?
Well, it depends upon how much complexity you want in your portfolio. These kinds of decisions, how much percent to this, how much percent to that is less important than your ability to stick to that allocation through thick and thin.
Hmm.
So there are people out there, and I think they're doing the right thing, who invest purely in the total stock market. They have an allocation to the US market, they have an allocation to the foreign market, and that's it. That's as complicated as they get. And there are other people who invest in 8 or 10 different equity asset classes, some of which you just mentioned. There's nothing wrong with doing that either. And the important thing is not which of them you choose, but how well you adhere to that as well. Now, the question is that you're really asking, I think, is how much do you want in international stocks? And the place to start is with the world market portfolio. And I haven't looked at it recently, but I think the world market portfolio is right now is pretty close to 60-40 foreign US. 10 years ago, it was the reverse. And so that's the place that you should start, a 60-40 US foreign allocation, at least as far as your stocks go. Now, you might say that, well, but I'm not a citizen of the world. I'm a citizen of the US and I'm investing in US dollars. So maybe I should overweight US, maybe 70-30. But then you could say, but foreign stocks are a good deal cheaper than they are than they usually are, and they're certainly a good deal cheaper than US stocks are. So that gets you back to, 60-40 or maybe even 50-50.
Sure.
So I think the world market portfolio is a perfectly good place to be right now. And you can buy that with one ETF.
Right. And
That's great.
we talked for a second about tariffs. How does geopolitical risk, and I'm going to throw tariffs into that just because it's basically we're kind of dealing with every country in the world. How does geopolitical risk influence your long-term investment strategy?
Yeah, I like to channel Ken Fisher, bless his soul, uh, who observed that he pays close attention to the headlines because he knows that if something is above the fold, that is, it's the top of the headlines, it's kind of an archaic term, I guess, showing my age. If something is above the fold, then it's already been impounded into the prices, so he knows he can ignore it. And those are the kinds of things that fit into that category. Geopolitical risk, what's the Fed's doing? Everybody knows about that stuff. It's impounded in the prices. And that's not a new observation. I think it was almost over 100 years ago that Bernard Baruch said that something that everyone knows isn't worth knowing.
If it's in the paper, it's in the price, is usually what I
Exactly.
tell people.
That's a great way to put it. Yeah.
Yeah.
Yeah, yeah. We tend to be bottoms up here at the Fool, and so we get a lot of questions, particularly around the tariff noise. And we can point to them and tell them, hey, in 2016, there was a similar conversation that was going on, and here's what happened then. Most of those international stocks traded down pretty significantly once the presidential election happened in 2016, and then the year afterwards, international stocks took off. With I think China was the best performing, up probably over 50% in 2016 during President Trump's first year in office. So we can tell them the data, but it's hard because people focus on what's in the newspaper. And I'm like, if you can just keep your goalposts focused on how the business is doing in the company and pick good businesses, you're probably better off because the noise is immense that is out there,
Yeah. If
right?
there's one kind of data I tend to pay attention to, I do it as a negative indicator, which is you'll often hear people say, country X up Y or Z has a great economy, it's going to take off, buy its stocks. And
Yeah.
it turns out that there's an inverse correlation there. And there are a
Uh,
lot of different reasons for that. But the poster child for that phenomenon is China. Over the past 30 years, economic growth in China has been through the roof, almost 10% real over the past 30 years, every single year. And yet, over the past 30 years, Chinese stocks have been money losers. They've had terrible returns for, again, many, many different reasons. So that's one argument that I tend to pay attention to because it's so specious that it usually works out the opposite direction.
Yeah, and I remember when the BRICS were all a big thing, and that was Brazil, Russia, India, and China, and they were the emerging growth stories. Well, I think over longer periods of time, those emerging market stocks tend to perform less than the developed world because, as you like to say, everybody runs towards the growth, and then the multiples get bid up. But we even had some members that posted some ETFs that because they wanted exposure to the growing middle class of China, which is a smart thing, right? I mean, they had huge growing middle class. But if you looked at some of the ETFs that were available for investors, most of those were investing in government run entities in China. They were state owned enterprises like banks and manufacturing and stuff like that. And they were getting very little exposure to the rise of the Chinese consumer. So I said, you got to be careful sometime when you just look at some of these ETFs that think they're meeting your need. You got to understand what's in them as well.
Yeah, there's a more general principle, epistemological principle here, which is that narratives and stories are very misleading. We're human beings, we tell each other stories, that's how we communicate. That's a really lousy way to invest. If you're buying a story, you're very liable to have your head handed to you. What you should be looking at is the data. And what's the data? It's the valuation. What kind of
Yeah.
earnings yield are you getting? What kind of dividend yield are you getting? That's what you should be. That's what you should be paying attention to.
Yeah.
Yeah.
That's great.
Go ahead, Buck.
I was going to say, you've talked a lot about behavioral finance and psychological tendencies. I think, investors that are trained in those tend to do better and they protect themselves from making a lot of mistakes. So I want to spend a little bit of time on that. I grew up, we had one investor in my household, and that was my mother. And she was probably the best investor I've ever known because she's had the ability to buy good companies and hold them for 6 decades. Those are, companies like Apple and Microsoft and things like that. And at the end of her life, I mean, your portfolio reflected the fact that she held on to her winners. And I want to just ask you a little bit about people that are just beginning. And I've worked a lot with our interns this summer, as well as many summers before. And I've seen a difference between men and women investors. Like I said, I grew up lifelong relationship and investing with my mother. She was very patient with her stocks. Men that I know tend not to be. They tend to want to buy and sell and trade a little bit more. I just want to know, like, for people that are beginning investing, and I'm talking about people that are pretty humble here and they're scared to lose money on their first investment. They're scared to take that first leap. And I tell them, if you're great, you're going to be wrong 40% of the time. Don't sweat it, right? Like, it's fine. What do you tell those people that are a little scared to get started because they're going to buy that first investment, whether it's a stock or ETF, and afraid it's going to go down?
Yeah. Before I answer that question, the first thing you talked about, the gender difference, is quite salient. Testosterone does wonderful things for muscle mass and reflex time. It does not do good things for judgment.
Yeah.
And so women tend to be better investors than
Yeah.
men are. Now, as far as what you do, with your first investment, you have to find out what kind of person you are. And I tell people who are starting out to invest relatively conservatively, so that when they
Mhm.
hit their first bear market, they find out what their actual risk tolerance is. So the
Yes.
first person, the first investment that a person makes, I generally tell them start with a 50-50 portfolio. And when the market goes down 50%, which is liable to happen some point in your first 10 or 15 years of investing, then you're going to find out who you are. And
Yes.
if you bought more or you held on, fine, you know what to do. You're either going to keep that allocation or you're going to up your equity allocation. But if it ruins your life, maybe you should be 30-70 for the rest of your life, because that may be suboptimal, but a suboptimal allocation that you can execute is better than an optimal one, a stock heavy one that you can't execute.
Right.
Mm.
Yeah, and you're so right because we've asked people many questions over the years to try and get at their level of risk tolerance, and like asking them, hey, what would you do if your stocks went down 30%? Like if you looked at, and you can kind of ask those people up front, but if it's during a bull market, it seems like their risk tolerance is much greater than when it actually happens to them and they experience it. So the tolerance for risk seems to change over time. So that's a tough one to get the handle on for most folks.
Yeah, finance academics, have a lot of really stupid assumptions. But one of the dumbest assumptions that I see academic finance people make is they assume that people's risk tolerance is constant throughout their life because that simplifies their equations. That is, as you just pointed out, certainly not true. At the top of the market, everybody's everybody has low risk aversion. Everybody's a buy and hold investor, and at the bottom of the market, not so much.
Yeah,
Yeah.
yeah. Now we and I'll go over to Rich here, but I want one more because recently when we had the most recent in April when the tariffs were announced, and we had a lot of volatility. I mean, typically you don't see a 1 or 2, 1% movement either way in the market, but we were seeing them every day, sometimes 3 and 4%, movements for folks, and we tried to tell people that, hey, usually during the biggest downturn days are also associated very closely with the biggest upturn in days. So if you just do nothing, you're probably better off than panicking and selling. And if you have the courage to add a little bit on those down days, probably works out pretty good. Do you have any advice for people? Because we know it's going to happen, as you said. It happened in 2001, we happened in 2008 and 2009. We saw a big drawdown in stocks, and we saw one even recently here in April. Do you have any advice for people beforehand on what they can do to prepare for the next downturn that so that maybe they will have the courage to step up and buy some stocks
Well, what I like to
or
tell
ETFs?
people is that the most magical thing, the most powerful force in investing is the law of compound interest. All right. And Charlie Munger very famously said that the prime directive of compound interest is to never interrupt it. So then you ask yourself, well, when am I most liable to interrupt compounding? Well, it's when it looks like the sky is falling. So what I tell
Yeah.
people is they should design their portfolio for the 2% of the time when it looks like the world is ending. In other words, you design your portfolio with the worst 2% of the time in mind. And the analogy to that is it's how you design ships and aircraft too. You don't design an aircraft to fly in smooth air. You design an aircraft so that it can survive the most turbulent conditions. The same thing when you design ships as well. You don't design ships to sail in smooth water. The same way you should be designing your portfolio for the worst 2% of the time. Well, what does that mean? That means that you're going to be more conservative than you think you should. If you think you're a 60-40 person, maybe you should be 50-50. Maybe you should be 40-60, okay? Because when the excrement hits the ventilating system, you want to be able to keep investing and not panic and sell. And 40-60 may not have as high an expected return as 60-40, but you can't execute 60-40. That's the problem.
Yeah, and I want to be clear for the listeners. When you say 60-40, you're saying 60% stocks, 40% bonds.
Right.
And when you say you might be a 40-60% person, you might have 40% in bonds and 60% in stocks, which would be less volatile during those drawdowns.
Yeah. Warren Buffett doesn't invest 100% of Berkshire in stocks. He typically has 20% in T-bills. He now has about, last I saw, he had 30% in T-bills. And if 20 or 30% in T-bills is good enough for Warren Buffett, well, it's good enough for me.
Yeah. Oh, 325 billion sitting now in cash, which is easier to do when it's earning 4 or 5% than when it was earning 0%. But he has said, and he said this at the annual meeting, that he would have made the decision to sell down his Apple stake and hold that much cash, even if interest rates were still as low as they were just a few years ago.
Yeah, it's not in every Berkshire report, but most Berkshire reports have a little passage in there that says, T-bills suck. They have low yields. You don't know what you're reinvesting them in at. And then the last sentence is always, however, we will continue to invest 20% of our assets in treasury bills and cash equivalents.
Yeah. So this gives it, so everybody has some amount of cash, and people probably don't waste their time like I do. I'm head of our 401k investment committee here at the Motley Fool. And so I spend time looking through 11Ks to find out what other people are doing and what things they have in their 401k plans. And I always see a big chunk that's in like a guaranteed interest fund, which is yielding like 1 or 2%. We have one of those at the Motley Fool. We also have a money market fund, which is yielding closer to 4.5% these days. I just wonder, like, for cash that people are going to keep for a while, what do you recommend for that? And we haven't talked about tips at all, which are Treasury inflation protected securities that you can buy at treasurydirect.gov. Just do you have any thoughts on tips, and what do people do with that cash that they're holding for something later on down the line?
Well, it depends upon what your time horizon is. What are tips for? Well, tips are for the person who is retired. They have no more human capital left. They're not making any more salary, and they have fixed obligations, fixed expenses in real terms, in inflation-adjusted terms that may go out for 20 or 30 years. Well, that's why God made tips ladders. All right. So you can't do them every single year because there's a gap between, I think, 35 and 40, 2035 and 2040. But if you're 65 years old, there is nothing wrong with owning a ladder of tips. You don't have to have them maturing every year, maybe every other year, so that you know that your real expenses can be met each and every year until you're pushing up the daisies. All right. So that's what tips are for. It's for the retired person who wants to sleep at night and know that their expenses are covered until they're very, very old. What I like to tell people is when I can't sleep at night, I don't count sheep. I count my tips. All right. Now, tips are not for young investors. And And a young investor wants to have cash reserves so that when they lose their job or when things look really awful in the market, they can sleep at night. They can pay for their groceries. So that's what T-bills are for. And when I say treasuries, I mean T-bills. I mean things that are relatively short, 1-2 years maturity at most. A treasury bill is a riskless asset from a short-term point of view. Okay, but from a long-term point of view, it's actually pretty risky because you never know what you're going to be reinvesting at. Whereas a TIPS, on the other hand, is riskless when held to maturity, which can be as long as 30 years. You know exactly what you're going to be able to consume with it whenever it matures. But until it matures, it can be very risky. Between 2022 and last year, the 30-year TIPS lost about 50% of its principal value. But when held to maturity, it's riskless.
Yes. Yeah.
Bill, how do you think AI and machine learning might reshape personal investing, in the near term, over the next decade, whatever timeline you want to use?
I can't imagine it's going to have much effect at all, because let's say there's an AI algorithm out there that holds some advantage. Well, then the people who are going to trade opposite that are also going to be using AI, all right? And at the end of the day, AI versus AI still winds up with the market return. All right. So when you are trading, when you're buying or selling a stock, you have to ask yourself, who is on the other side of that trade? And the answer is almost always it's somebody who's smarter than you and has better information than you do and is working harder than you do. So what's the solution to that? The solution to that is not to trade. Buy and hold the market and go play golf.
Yeah.
And it doesn't matter whether that really smart person on the other side of your trade is Warren Buffett or Goldman Sachs, or whether it's somebody's AI algorithm. Don't trade with them. Own the market.
Yeah. And one follow-up, thinking of kind of more moral and ethical dimensions when it comes to investing, should investors be considering ESG or impact investing? Is that something that you consider important?
No, not at all. The way that I like to think about it is that all that you're doing when you invest in ESG is you're making yourself feel good. All right. That's the main thing that you're doing. So let's say you don't want to own oil stocks, tobacco stocks, gun manufacturers. All you're doing when a good number of people don't want to own those is you're depressing the price of those stocks, and you are increasing the expected return for the people who do hold them. All right. So a couple of different things happen when you do that. Probably the most important thing that happens is that you depress the share price of those stocks, that they become cheap enough that they get taken private. All right. Well, when a company gets taken private, it gets removed even more from public scrutiny than when it's publicly traded. So that's a really bad thing. What is the smart thing to do? The smart thing to do is to own those stocks as part of a market portfolio. And with the excess return you're making off the people who are ESG investors, who are going to, on average, wind up behind the eight ball, then donate to advocacy. Use that money to the excess profits you make from owning the gun manufacturers and the oil companies, and invest in environmental causes. And for God's sakes, keep those companies public, because if they go private, you're in, the world's in even worse shape.
Right.
What happens when hospitals get taken over and nursing homes get taken over by private equity? Those aren't good things that happen.
Right.
Yeah. I want to talk about rebalancing here, and I know you've talked a lot about index funds and ETFs. And we're big fans of those, as well as we're great fans of John Bogle, and he did probably more for individual investors than anybody, and I know you have as well. But we have a lot of folks that buy individual stocks here. Some do index plus a few, is what we call. You buy an index fund and you build around your favorite positions. Some of those people have had NVIDIA, which has been a recommendation across many of our services, and some other great stocks. And now they find themselves in a wonderful position, where one stock might make up 20, 30, or I've even heard some people say 45% of my portfolio is in a single stock. Do you have any suggestions for those people on how to rebalance, and when should you rebalance a portfolio?
Yeah, that's why I don't invest in individual stocks. You don't want to wind up in that situation, because that's a really risky situation to be in. NVIDIA, I don't know whether it's got the world's largest market cap. I think that it does. But when you look at the history of the companies that have the largest market caps, let alone the largest market caps, it's not a happy history. Okay, when you buy mega, when you look at the cross section of equity returns, the very largest firms at any given moment are usually the ones that have the lowest returns going forward, for obvious reasons. How much more of the chip market is NVIDIA really going to take at this point? Were I to inherit somebody's NVIDIA stock, I would just bite the bullet and take the capital gains. I might keep a residual position just so I minimize regret in case it kept on going up. But the smart thing to do in that case is to take the capital gains, or better yet, donate it to charity.
Yeah. Even within, let's say, your portfolio in your 401k, people ask us now, there's services that are sold where they'll rebalance. You can rebalance quarterly. You can even rebalance daily to keep whatever allocation that you set, whether it's 60/40 or 70/30 or whatever else. How often do you think you should rebalance between sectors, let's say small caps and large caps and those kind of things? Obviously, people that have owned large cap, growth mutual funds or ETFs, they've grown to be a big part of their portfolio now, as those Mag 7 stocks and those have grown tremendously over the last decade or so.
Yeah, that's a really good question. When you rebalance, you're making a bet, okay? And you're betting that things that have done well will do less well, relatively speaking, going forward, and vice versa. You're betting that the first will be last and the last will be first. All right. How to what extent is that true? I talked previously about 55-45 bet. That is maybe a 51-49 bet. All right.
Okay.
So what you want to do, at least theoretically, is take advantage of short-term momentum, which operates up to a time frame of about a year. And you want to also take advantage of long-term mean reversion, which tends to be maximal over several years. So when you put those two things together, you come up with an optimal rebalancing frequency of something like every 2 or 3 or 4 years. So that's about right.
Okay.
And there's probably nothing wrong with annual rebalancing, but you should be using it more sparingly than that. I use thresholds. And there's different thresholds for each asset class. So when it hits a certain bound, I rebalance back only, of course, if it's in a sheltered account. I don't do it in taxable accounts because that generates more capital gains than it's worth. And I find that over the long term, if I find myself rebalancing every 6 months or every year, my bounds aren't wide enough. Okay, and if I never rebalance, my bounds are too wide. And if I find that I'm rebalancing asset classes on average once every 2 or 3 years, I'm probably doing it about right.
Okay, that's good to hear, because I generally tell folks to consider longer rebalance cycles, because I think just like the natural cycle for me seems to be about 5 or 6 years, where you'll see, if you look at different asset classes, large caps may do well for 5 or 6 years. They generally aren't the best asset class the next 5 years, right? But I think selling after a year or so seems to me a little bit premature. I also think about that with even individual stocks, that I like to let winners run. We generally say that around here. And, we've seen here, we talked about small caps and large caps. In that same article, they said, I think people sold 12 billion worth of small caps this year out of small cap funds, and they've put 150 billion into large cap growth funds this year alone. And so we can kind of see, being a little counter to that might be helpful too for folks.
Yeah, I mean, mutual fund, if you really want to play that game, and I don't advise it, but look at fund flows, all right?
Yeah.
When an asset class gets a lot of fund flow, that's the time when maybe you should be rebalancing out of it, and vice versa. I mean, my
Yeah.
favorite is
Yeah.
my favorite sort of, if you want to play this game, signal is when you see people talking about an asset class as not belonging in your portfolio anymore. And typically, that people say that about emerging markets, or they say that about precious metals, when those two asset classes have had really lousy realized returns over the past several years. When someone says that gold or precious metals doesn't belong in your portfolio, that's the time to buy it. Okay,
Yes.
and it's the same thing with emerging markets as well. Recently, over the past couple of years, people have questioned why emerging markets should be in your portfolio. When I hear that, my ears pick up.
Yeah. We had an applicant years ago, they called and they posted in their application their kind of investment returns as an individual investor. So I called them up and I said, those are impressive. What is your model? Like, how are you doing that? And it turns out they work for a really big financial firm and they worked in the call center. And they said it's actually kind of easy. Now, they didn't really know how to analyze stocks or anything else, but they said, well, we get a lot of calls for people all selling. I buy stocks. And when everybody's buying and they've kind of gone and I see like nobody is selling stocks, then I lighten up a little bit. And I'm like, that you did that for years and it worked really well because he was at a very large financial. I'm like, that's pretty smart.
Yeah,
Yeah.
I mean, you don't have to work in a call center to do that. I mean, just talk to your friends. It's
Yeah.
the same basic thing.
Yeah.
I had a relative who, at the height of the uh, dot-com bubble, for the first time joined an investment club. This is a person who had
Yeah.
never even thought about investing, but in 1998, that person joined an investment club, and to me, that was a signal.
Yeah. Yeah.
Bill, obviously we've talked here that, even the best investors, are 55-45 or, what have you in terms of performance, the winners versus losers. As you look back at your investing career, what's your biggest investing mistake? And from a psychological standpoint, what, lesson did you take from it?
The most expensive investing mistake I ever made was not investing 100% in equities when I was accumulating assets, when I was saving.
Mm.
Because it turns out that stocks are very, very risky. They are extremely risky if you're retired and you have no more human capital. But if you're very young and you have a lot of human capital and you are periodically saving a good part of your salary, the smartest thing to do by far is to invest in equities, because at some point they're going to do really poorly and you're going to be buying at very low prices and
Mm.
you're going to do very well. That was the single biggest mistake I made, was investing at most 50-50 or 60-40 throughout my younger investing years. And I wished I hadn't have done that, but I'm not going to complain. I mean, if my net worth were 3 times higher than it is now, I don't think I'd be any happier.
Right.
Right.
Great.
Well, I'll add my biggest mistake has been selling off my winning stocks too early. And I did that early. I remember Netflix was one of those that during a downturn, I think it was 2008, 2009, and I keep an investing journal of all my decisions so I can learn from those mistakes. And I said, hey, I think it's about 30% undervalued here, but I see some stocks out there that are much cheaper. So I'm going to rebalance. It was not in a taxable account, Bill, so you'll be happy about that. I didn't pay taxes on those gains. But when I look back at how well Netflix has done, I should have just stayed in that winner. And I've made a rule for myself since then. I don't sell stocks for a non-business reason. In other words, valuation is part of that. The only reason I would sell it off is it got to a level in my portfolio where I couldn't sleep well at night if it went down 40%.
Yeah,
If it gets to that level, it impacts the way I live. I'm going to sell down that stock regardless how good it looks. But just on valuation, I don't sell stocks just on valuation anymore.
yeah. The other thing that we're talking about here, we talked about recently, 10 minutes ago, had to do with rebalancing. Rebalancing is a smart thing to do, or can be a smart thing to do at the asset class level. But at the individual stock level, it's not a smart thing to do. And the reason for that
Yeah.
is that only 3 or 4% of stocks produced all of the entire equity risk premium, all of the return in excess of T-bills. And those are stocks that are, your 10 and 50 and 200 baggers. Okay. So it's a mistake to sell those off too early. And the trick is you're looking for a needle in a haystack. So if you only own 20 stocks, you may not own any of those super stocks and you're going to have lousy returns. That's the problem with a concentrated portfolio, is you're really buying a small number of lottery tickets. You're looking for a needle in the haystack. And as John Bogle said, the smartest thing you can do is just buy and hold the whole haystack. And then you're going to get all those winners.
Then you get all that. And then if there are some that you want to kind of double down on, you can buy those outside of the index. If you say, hey, I really like this particular stock, maybe it's not in the S&P 500, you own that. You can go ahead and buy that, and hold that there. So we're winding up here. We have a few minutes left. I want to throw out some of your favorite sayings that I've enjoyed across some of your books, and I just want you to say what comes to mind when you think about them. One is if about simplicity. If you own more than 3 mutual funds, you're doing something wrong.
Yeah, I'm not really sure I actually believe that because my portfolio is more complex than that. But if you own 3 different mutual funds and they're all investing in large cap US stocks, yes, you're doing something wrong. If you own 3 mutual funds and one owns big stocks, one owns small stocks, and one owns foreign stocks, you're doing just fine.
Okay, that's great. And related to that, we haven't talked about target date funds. Do you have any thoughts, Bill, on target date funds? They're you in the Motley Fool universe. They are the number one option for new employees. Most of their money is going into target date funds. Do you have a thought on those?
I think the target date funds are a marvelous vehicle for the typical investor who doesn't want to think about investing, who's frightened of it. And my advice to you is if you have a 401k plan and it's got an inexpensive target date fund, one of the Fidelity Index, Freedom Index funds, not the Freedom funds, but the Freedom Index funds, or any Vanguard fund, any BlackRock target date fund, then you should keep that as your default. Don't even look at your statements more than once a year. Just look at your statements once a year to make sure that there's nothing unkosher going on in them. And don't look at your accounts. Don't follow your account balances. And do that for 30 years, and you're going to probably be just fine. When you look at the dollar time weighted gap, that is how much investors are losing by trading funds, target date funds are at the very top of that list. There's almost no gap with target date funds, whereas the more specialized a mutual fund is, the lower the return that people get relative to the return of the fund.
Right. That's great. That's great. I'm glad to hear that because when we auto enroll folks into our 401k plan, that's what they get put into a target date. So I'm happy to hear about that. Couple more of my favorite Bill Bernstein comments. The market gives you no information about what it will do tomorrow.
Yeah, that's absolutely true. And that's the weak form of market efficiency, which is the most valid form of it, which is that you can't look at market patterns, you can't look at charts and figure out what the market is going to do 10 minutes from now. Oh, the market's going up, look, it's going up. That means it's going to go up further in the next 10 minutes. No. Same thing happens at the time frame of a day or a month. Looking at charts will drive you crazy and will usually lead you to do the wrong thing.
Yes. And I get lots of questions from people about which stock do you think will do X in the next 6 months? Which one's the best? And I'm just telling you, listen, I can tell you which companies I think are good and will do well over the next 5 to 10 years. I cannot tell you where the stock price is going tomorrow, 6 months from now, or 9 months from now. It's too complex. So don't ask me about where stock prices are going.
Yeah.
Another last one I'll give you from Bill's comments. The goal of investing is to maximize the amount that goes into your pocket, not the amount of activity that goes into your portfolio.
That sounds more like Jack Bogle, but that's absolutely true. When you're going to Vegas, and the trick is to become the house and not play against the house.
Yeah, yeah, that's great advice. Rich, I'll let you conclude things.
Yeah.
I've covered my questions, and I'd just like to thank you, Bill, for taking your time to share your wisdom with us and the rest of the investors that are listening. But Rich, I'll turn it over to you.
Yeah, Bill, this has been terrific. I've got one last question for you. In Birth of Plenty, you talk about conditions that created modern wealth. Do you see any of those pillars at risk today?
Oh yeah, I am very worried about the independence of the judiciary and the rule of law. And I'm also very worried about the decline of scientific rationalism. I'm scared to death when I see some of the policy, healthcare policy allocation decisions I see being made. They frighten me to death, and I'm also frightened that the attack on the judiciary also frightens me.
Okay. Bill Bernstein, thank you so much for your time. Thank you for coming on Motley Fool Conversations. It's been a real pleasure.
My pleasure, too.
Take care.
Thank you. And Fool on.
Fool on.